Hey, good morning, everyone. Welcome and appreciate you taking the time to join here this morning. The CPI number is coming out right now at 7:30, so we're kind of watching to see how markets react to that, which it doesn't look like it's going to be overwhelmingly bearish. So um, any number below expectations would be bullish commodities. Any number above expectations would have been bearish. I don't know what that number is yet, and I'm not going to spend a whole lot of time digging around to find it. I think we'll find out soon enough. So let's just jump right into it. Okay, lots happening, and there's a lot of frustration in these markets because we're just chopping sideways, right? And we were talking yesterday. It seems like every hour bar is like either panic buying or panic selling, and we're seeing 10, 15, sometimes 20-cent swings in a matter of seconds. And so that puts you on edge because it's hard to sit there and watch. So I think that the best thing that we can do is spend a few minutes with the fundamentals and try to understand why the market is putting itself in the position that it's in. And I think it becomes pretty self-evident what's happening when we really dig in and digest it, right? So on its most basic level, everything comes down to this one number, which is ending stocks. If you've been following us for a long time, we say this on a regular basis. Um, if there's excess supply, we have lower prices. That would be a higher carryout. If we have lower carryout numbers, we have higher prices because you have to ration demand. It's very, very basic economics. You can say this in one or two ways. You can say it's a straight number, 1,470,000,000 bushels of corn left over at the end of the year. Is how do you know if that's good or bad? Well, we know it's good or bad based on the ending the stocks to use ratio, which is how many stocks do we have left out of the total usage. And the USDA seems to be pretty happy with this 10% number. So you would assume that if our ending carryout starts to dip below 10%, then we should see higher prices. And if we start to see it creep up above 11, 12, 13%, you should see lower prices. And that's going to correspond to a higher carryout. So what is happening in the marketplace that is going to adjust this carryout? Well, there's only a couple buckets that we can do, that we can debate right now. That is the number of acres planted, the number of acres harvested, and what the yield is going to be. Then the second piece of the equation is always how much of it are we going to use? What's our demand for it? And the demand can be broken down into three really big categories for corn, right? You can break it down into feed. How many cattle are out there and how much are they going to use? We can break it down into exports. How many bushels does China need to buy, or Europe? And the third section would be ethanol. How strong is the energy market? Because corn can also be fuel. So now, if you just take these kind of one at a time, ethanol is really not up for debate at the moment. The grind is strong, and I don't think anybody's arguing that it isn't. The cattle number, the feed number, is if you look at the drought that's taking place, and you see the number of cows that are being sold because they don't have enough grass to keep them, that would imply a decline in future usage for corn. So there's some argument that we don't need as much just because there's enough destruction of the cattle supply that we may not have that. And then the third and the big one is exports, right? And that comes down to politics. So we cannot control anything about that. And then on the supply side, we have the weather. And we obviously don't have any control over that either. So on Friday, the USDA is going to come out and they're going to give us an August report, and they're going to give us some sort of a shift in these numbers. They could choose to do nothing and just hold everything the same, or they could choose to start moving these numbers around a little bit. So let's kind of walk through what they might do. Because as you look at the charts, what you see is neutrality. We see a very confused market, and we see everything trading kind of right into the middle of its ranges. So why are we doing that? Well, the reason is because if you look at the weather, it's bullish. I don't think there's anybody arguing that these yield numbers are going to go higher. I mean, there might be a few outliers out there that say, oh, we're at 178, 179 for corn. But then Pro Farmer comes out and says we're at 167.2, which obviously would be very, very bullish because it drops our stocks to use and carry out and our ending stocks carry out to below pipeline levels. So the USDA is probably not going to be that aggressive. I don't think they're also going to stick at 177. I think they're going to be conservative and they're going to move it down to something like 175 or maybe 175 and a half, okay? So then the question is, what are they going to do with this number? And I lump all of our usage into one number. So those three big buckets, I consolidate all into one just to make the spreadsheet a little easier to see. What if they decide to decrease yield a little bit, but then offset that with an adjustment to feed residual and an adjustment to Ukraine exports? So the USDA could decrease our exports by a little bit, and I think this would be a really drastic, nobody's calling for this number, but that would push the number a little bit higher. So what they might try to do is split the melon to make sure that the 10% ending stocks to use number holds true, right? So you could decline by two bushels an acre, and you could decline by just enough to hold this number at 10%, and then let the market figure it out from there. I think that that's probably somewhere close to what they're going to try to do. But as you read the private forecasters, they are leaning more towards a balance sheet that looks like this because the weather is not good. And the more information that comes out, the smaller the crop seems to be. There's a lot of people in the 172 range, 170. That's anybody's guess. But the critical thing to me is that I can't find anybody that seriously believes that our export number is really going to come down dramatically, and I can't find anybody that believes that our usage overall is going to be lower. In fact, there are some people that think it might be higher because the USDA is overstating the European production and they're overstating the exports coming out of the Ukraine. So if those bushels flow to us, then we could be very, very tight and it could be very explosive. So with corn, we've been saying this, the range of potential ending carryouts is very wide and can create explosion either direction, right? Now remember, the last bushel needed is infinitely more valuable than the first bushel not in this business. So any movement away from this 10% number is going to cause an extreme move. And if you're going to see an extreme move, what would you typically see in your chart pattern? Well, you're going to see consolidation, and you're going to see an absolute neutral market. And what do you know? That's exactly what we have. So the market is fishing for information, and it's looking for some sort of confirmation of a move. So now, what does that mean for us as producers? Where are we at? We're getting ready to get into harvest. There's a big group of analysts that think that we're going to have a lot of harvest pressure coming into September and October, which certainly can happen. And their logic is that would be difficult to forge a rally in the face of that harvest pressure. So if you're worried about that, and I'm not going to argue with anybody here, we've been saying for a while that this range right in here is our baseline. We want to sell anything below that because we don't know how far it'll drop. But if you want to be a little bit more aggressive ahead of it and sleep well at night, we are sitting right in this triangle. And this morning you can do a $7, you can sell a $7 call and you can buy a $6 put for only 14 cents, which gives you a true floor right at this low. It's amazing how efficient options are because they're giving you that opportunity right there, and it's not going to cost a whole lot of money, and it gives you some upside all the way to 7, and it gives you an absolute floor right here at 587 because the $7 call is worth 16 cents and the $6 put is worth 31. So you do the math and you end up right in here. So I think that that's a really nice setup for people, and I'm not going to argue with anybody that wants to do that, because we can't rule out the possibility that these trend lines hold and that we break out of this triangle to the downside. So I think having some protection on is wise, especially if you're having trouble sleeping at night or really worried about it. $6 as a floor is a nice number, and it'll give us some opportunities to adjust it and hedge from there. Okay, that's corn. Now let's look at soybeans, because you have basically the same setup in beans, right? You have this big wedge that we've been forging since the beginning of June, which is, we're not quite as sideways as corn has been because the volatility is so high. And why is that? Well, because look at our carryout range. Our carryout range is insane with beans. If we hold acres the same and we hold harvested acres the same, and we adjust bushels by somewhere around 3 bushel an acre, and don't do a whole lot with demand, our carryout range is maybe as extreme as it's ever been. I mean, at a 48.9, which is the pro farmer number, at current demand levels, we have zero carryout, or it's even negative. So that can't be true. That can't happen. The market won't let that happen. So you either have to kill demand, or our yield's going to be higher than that. And so I don't know where this goes, but this is pretty extreme, right? 450 million bushel carry out based on demand destruction, because we get into a political situation with China or whatever. You're talking $8 beans if this becomes true. Here, you're talking beans that are a lot higher and will eclipse the all-time highs if that becomes true as well. So you've got the same setup as corn, which can be really explosive. And here we are in the pre-market hours, working ourselves up a little bit higher. So beans are caught right between the 200-day moving average and the 100-day moving average. We're caught right in this wedge, and the risk to the downside is real, even though the fundamentals, as I see it today, are really pretty bullish, and we should move back up above, back up higher. So as a technical analyst, it's really difficult when you see this type of setup, because you can make bearish and bullish arguments, right? If you're in the mid-range, well, look at all the support we've traded back on top of. The support that's held since February on every major break, we are now back on top of it, which creates a bear trap down here. So that's extremely bullish. Now, on the other hand, we've had this big move down with a 3-wave rally back up into the middle of a range, and we're right between the two major moving averages. So any weakness could get accelerated to the downside, and consolidation typically favors continuation. So you can see this both ways. So what's the market giving us? As far as soybeans go, the market is giving us a $15, $14 short call long put spread for a 12-cent risk. So you can lock in a true floor of 1388, which is this low right here, which is also the 200-day moving average, for 12 cents off of today's price. That's not a bad deal if you're worried about lower prices. Also, if you wanted to sell cash and get some protection below these recent peaks, I think that's fine, but you have to be prepared to open it back up if we break them and close above them. Because if the weather does hold true and our crop does get smaller, then this peak is very much in jeopardy for both corn and beans. And I can't stress that enough. It's remarkable just how bullish those fundamentals could be. So why did this weather rally get sold? Well, it's because of the demand number I showed you, right? If we are worried about demand destruction, then that's what you're going to get. You're going to get a breakaway move, and it's going to be very hard to catch up to. So I'm not going to argue with anybody that wants to put a position on like that or get to 50, 60% sold. But I say that with the caveat that the recipe is in existence to push us higher, and this is not a risk-free hedge that's got a lot of clarity around it. But I do think 15, 14 is a nice move. I think a cash sale here getting up to that 50, 60, 70% of what you expect to harvest is also a prudent move. So let's spend a couple minutes on wheat, right? Because it just seems like it's going nowhere, and it seems like it's going everywhere all at once, and that's because it is. Every day is a 30, 40 cent range in wheat, and the volume is terrible. But if you zoom out, what have we done here? We have this downtrend line that we've actually broken, and now we're testing, and now we're pulling back away from it. If wheat is able to close above a couple of prior days highs and is able to do that a couple days in a row, it could create a very very quick short covering rally that would come and challenge this $10 number, maybe even higher just off of velocity and momentum, right? A 38.2% retracement of the entire move down is all the way back up at 1035, and a 61 is up here at 1166. I don't know what would drive it that high, but something like a 167 or 168 corn yield would certainly do it. We just don't have the room for that type of yield loss coming from the corn market. So stay tuned on wheat. You can see this both ways too, just like corn and beans. If corn and beans break lower, then these lows are going to be at risk and in jeopardy. If they hold and get stronger, then I think the shorts are going to get nervous and have to cover a little bit and come put some pressure on these. So I think patience is warranted there, and I think prudence is to say hedge a little bit of wheat and or corn and beans using those strikes that we talked about. That is sell a $7 call in corn, buy a $6 put, sell a $15 call in beans, and buy a $14 put. Those give you nice solid numbers, or just go sell cash, but be prepared to re-own it or put some sort of a long position back on if the highs start to get broken and we materialize some of these bullish fundamentals that are out there, because I think that could get really explosive really fast if the market decides it needs to do that. So I absolutely do not think that this is a good spec short. I would not want to sell this at all. I think that the risk of an explosive move higher is simply too much. So I wouldn't sell it, and strength above these highs probably needs to be bought as a spec. Otherwise, anything above these lows down here should be held as a spec. That's kind of how we're viewing the world. If we trade back down into here and give up the 200-day and come back below this trend line, then maybe we'll start looking at selling it. But we need to see what the fundamentals do first. Okay, that's 17 minutes. Threw a lot of information at you. I know that I know these markets are tricky and frustrating, but stay tuned, because what comes after a long period of consolidation is usually a fairly dramatic move. And we'll have to see where we are, Monday, Tuesday next week before we really know how the market's starting to digest this crop report that's coming our way. Remember, there's significant risk trading futures and options, and you should only do so in light of your own financial condition. I hope you guys have a great week. We will talk to you next Wednesday, unless we need to kick out an update sooner. Have a great day.